Sí.
Okay.
Morning.
Morning. Well, let's just go ahead and start. My wife works at a school. I'm not going to say what school because I'm going to talk bad about the school. But my wife works at a school, and she went to a training. And on the training, it was about a computer system, a new computer system. And she's an office manager from the school. And she told me that IT guys is the one that give you support to the system. And every office manager that was there, it was kind of upset that the IT guys that were not there. And I mean, when she told me this story, I went like, yeah, IT guys are like that. I mean, IT guys are like that they don't go to the trainings that they need to go to. But then it hit me, and what basically got to my brain was, guys, don't be an IT guy, because you're not going to trainings also. So yesterday was a training for the city of LA, and I don't know how many of you attended, but I didn't see some of you on the city of LA. But whenever you run into a loan with the city of LA, you go to Pulido, you go to me, and you're asking how to do it, and we say, well, Dulce is the only one that has a license. Go and talk to Dulce, and Dulce obviously is going to take some of your split, and then you get upset. But why are you upset with Dulce? Why are you upset with us if you're not going to these trainings? So don't be an IT guy, because this is your profession, and you need to be on top of every training. So try to be like that. I saw on the LA, or the city of LA, I saw a loan officer from Santa Clarita. If you can, guys, mute, or Dawson, can you mute everyone? So I saw an officer from Santa Clarita. If you talk to Ademar, I don't know if Ademar is here or not, but sometimes I talk to Ademar and says, well, I don't do loans in Santa Clarita because all the loans go through this guy, and this guy has a monopoly in Santa Clarita. Well, Santa Clarita is not the city of LA. So what is this guy doing in the training for the city of LA? So that gives you an idea of what you need to be on top of it. So just for something to chew on. So we're going to talk about corporate taxes right now. Corporate taxes, you can get paid corporate taxes by multiple ways, or you can use income in corporate taxes by multiple ways. One of the first ways is by the W-2. So you have a corporation, and the corporation pays you a regular pay stub and a regular W-2. We're going to review this one real quick. So we're going to review this one. 1 second. How do I go back to my email so I can open all the files? Okay. So for example, this taxes, when I see a personal tax, in line 1, they're wages in line 1, and the wages are $60,000. Now, if you don't see the W-2s, you don't know who these wages are from. So you need to review the W-2s to see who are these wages from. In the taxes, there's a husband and the spouse. So I don't know if the $60,000 are coming from his corporation. I don't know if the $60,000 are from him or from the spouse, or where is it coming from. So you need to review this. Now, the second thing that I see, I don't have the W-2s as of now. So I go to the corporate taxes. And there's a line where it says compensation to officers, 47, and salaries and wages, $17,000. If I add those two numbers, they add to $60,000. Now, I still don't know by this taxes, this is the corporation, I still don't know if the compensation for officers, it was actually him, and I don't know if the compensation of salary, $17,000, is actually the spouse. Now, I talked to him, and he told me, and there's sometimes in the pages, in the other pages on the corporate taxes, it tells you which is which, but not always it tells you that. Not always. So you have to request the W-2s. A little bit less. Okay, right there. So basically we have the 43,000 and the 17,000. Now, I talked to the client, and obviously he told me, he confirmed that $43,000 is his income, $17,000 is the income of his spouse. So the other way to get income is by the K1. The K1 is the actually ordinary business from the corporate taxes. So basically the corporation made $187,000. They had a total expenses of $122 on the line 20, and they had a net income of $65,000. Now this is $65,000. If the corporation didn't pay taxes, that I would know if the corporation paid taxes on this area, then this 65,000 are going to be distributed to the borrower. It's going to be distributed. So it has to be a K1. It has to be a K1. Now, I don't know at this point, and none of you know, if the borrower is 100% owner of the company. So on the K1, So K1 is number 21. Number 21. Number 21 is K1. Now, it could be that corporation pay taxes. If the corporation pay taxes, then I'm going to tell you how we're going to deal with that. But right now, if the corporation didn't pay taxes, which is in this area where it says tax and payments, if they didn't pay taxes, then this number, it gets distributed to the owners. Now, what you need to find out is who are the owners. In this case, my borrower is 100% owner of the company. 100% owner of the company, and he distributed himself $65,000. $65,000. That's basically the ordinary income and loss. This $65,000, I need to see it on his taxes. If you don't see it on his taxes were done incorrectly. Let me repeat that.
On his personal taxes, right?
On his personal taxes. If you don't see those $65,000 on his personal taxes, then the taxes were done incorrectly. Then you have one of the two, either the corporate taxes or the personal taxes is a draft. This happened to Gonzalo. Gonzalo, do you remember?
So the current income tax for him would be the 65 or the 47 from the 70, right?
That is correct, if I'm including the wife on the loan.
Right.
So if I'm including the wife on the loan, and I'm going to throw a curve here. If I'm including the wife on the loan, in theory, is the 47, the 13,000, and the $65,000 as of now. That's the income that I have. Now, is the wife owner of the company? No, just the husband. And the husband is 100% owner of the company, so that's him. Now,
scroll down a little bit. Okay.
You got it? Okay, well, we're going to talk about distribution later. So now, they have income as W-2. If they have income as W-2, they have a W-2 and they have another thing, pay stubs. So they have a W-2 and they have a pay stubs. So, hey, client, can you give me your pay stubs? Now, this is the curve that I'm going to throw at you. So this is my client. And my client, I want to take the name, he gets paid bi-weekly. And he gets paid bi-weekly, and he gets paid on a salary basis $3,000 bi-weekly. So if somebody can do this math for me, if they can divide, let's just do 24, 26, $3,000 times 26. $78,000. How much salary did the borrower earn last year? 47. Now he has a salary of 70,000. What salary can I use? The 47 or this or this? The 47. Does everybody understand that? What salary can I use? Right now he has a yearly salary of $70,000. He paid himself last year he paid himself 47. Which is the salary that I can use, the 47 or the 70? The 47. The 47. Why? Because he's self-employed. And if I'm self-employed, I can make my salary be whatever I want. And I'm the owner of the company, so I can make it whatever I want. I can make it 70, I can make it 90, I can make it 110. So it's not valid. It's not valid until I make my taxes again. Because I'm the self-employed, I'm the owner. Your salary is the one that you reported last year. I do need to see a pay stub, but your salary is the one that $47,000. But
Oscar,
yes,
it's not the possibility to calculate an increase. For example, is in 2001 he makes 20, in 2022 he makes 25, and in 23 he's going to make 30. It's not working like that.
no,
It's to be always 2 years before.
it's always the previous year or the
Okay.
average of the 2 years if you're using 2 years.
Okay.
It's always considered self-employment tax, and the W-2 is self-employed, so it's just average. They don't consider your current salary. But Maria, can you do a favor for me? This is the pay stub for the spouse, and the pay stub for the spouse is $2,000 biweekly. So if we multiply $2,000 times 26, that's $52,000. Now the wife is also salary, and she's making $2,000 biweekly. Now she's making $52,000. Last year she reported $17,000. Which salary can I use? 17 or 50? 50,000 because she's not the owner. 50,000 because she's not the owner. Now, if I go deep into it, if she's making $52,000, 52 we said, Maria? If we divide 52 by 12,
43.
She's making 4,300 every month. If I multiply 4,300 times 8.5, which is the pay stub that she's giving me, they're giving me a pay stub for September 15. Let's just throw that number. So if it's September 15, if she's making $2,000, she should be making year to date $36,000, and the year to date is $2,000. Can I use that income or cannot use that income? Yes, you can. Why? Because she's salary, and she got a salary increase. As long as we do a VOE, and I do a VOE with her husband, and her husband told me, yeah, but I just gave him a raise in March or in April, and the numbers make sense. This is the salary that I'm taking, 4,000. On his case, no. On her, since she's not the owner, I can use this salary. Make sense? Any questions? Any comments?
So in this case, if the wife were not salary and she's a wage earner and then change to salary, should we take the salary?
On the spouse, yes.
Okay.
So on every employee,
She was paying by hour and then to change to salary. We take the salary.
we take the salary. So on any employee, on any job, this is a specific job that we're talking about corporate taxes or anything, but any employee on any specific job, if you work part-time and now you're full-time, we take your full-time salary. If you had variable hours and now you're 40 hours every week and you prove to me that you're 40 hours every week and we do a verification of employment and it's 40 hours every week, we take your fully salary. Now, if the income doesn't jive in 2021, 2022, you give me a pay stub and the pay stub doesn't show 40 hours, it shows 37 hours, we're going to average the income.
If the wife made 20,000 last year, and now you have a pay stub where she's gonna make 60,000. And it's a husband, the owner of the corporation. Do you run the risk that they ask you for cancel checks?
Not necessarily. I don't think, especially, it depends a lot, Jorge, with the pay stub. The pay stub is actually a pay stub from ADP. So it depends a lot from who's giving you the pay stub. If the pay stub is a funky one that it gets done by an accountant, then maybe they will ask you for cancel checks.
And I think it's better if the VOE is done by the accountant than the husband, right?
Yeah. So what Jorge asked, if it's too far-fetched, the increase, will they ask me for cancel checks, making sure that the wife is getting these deposits? It could be. When you get a pay stub from ADP, you may not, because obviously you're using a
But
company.
they have a full-time job and then they have a part-time job.
Uh-huh.
So you always add it?
You need to have both jobs for 2 years. And if you have both jobs for 2 years, always for the last, with no interruptions, you can add the other part-time job also.
How overtime? How steady it needs to be?
Overtime is always, the logic has always been the last 2 years. So you need to be making the last 2 years overtime. Now lenders are a little bit flexible that at least you need to have it the previous year. So if you have 1 year of overtime, you can take the overtime and average the overtime. And the overtime is very tricky. Does FHA applies the same rule or not? So FHA overtime is very tricky because sometimes you get a change of position and the previous position didn't have overtime. So for example, if we run a VOE and last year the client didn't have overtime, we're in October. So you only have 9 months of overtime, you cannot use the overtime. If for whatever reason you have overtime last year, then you have more than 1 year. Between this months and last year, you already have a year and you can use the overtime and average the overtime. But at least you need 1 year of overtime. Okay, any questions with this? So when you get the corporate taxes, or you get the personal taxes, most of the times you ask the client for their taxes, and most of the times they only provide the personal taxes. So if they provide the personal taxes, you need to make sure that if they provide the personal taxes, if you see line 1 and you see income on line 1, you need the W-2s. You need the W-2s and the pay stubs. If on line 8 on the bottom, it says other income, and other income is $74,000. That other income, you don't know where it's coming from. So you need to make sure that you continue reviewing his personal taxes to see where this other income is coming from. Sometimes other income is cancellation of debt. So for example, if there was a client, they had a vehicle that it was repossessed, and the vehicle was repossessed and he owed $10,000. They came to an agreement and says, okay, you don't owe me anything, but I'm going to give you a 1099 for those $10,000. Those $10,000 you have to pay taxes. It's a cancellation of debt. Cancellation of debt is considered other income because you're going to pay taxes on it. Now, cancellation of debt, you cannot use it as income. So you need to make sure that you follow the line and you say, okay, other income, $74,000. So let me see. Give me 1 second. Let me see where the $74,000 are coming from. Now, I know that $64,000 are coming from royalties. Those $64,000, they should match the K1, which was actually $65,000. We're going to see why. And then he has $10,000 from Schedule C. So he has a Schedule C reported, and he has a partnership or rental income or XYZ of $64,000. So the $64,000 actually come from his K1 and rental property income. So you have to continue with the taxes and you have to tell them, hey, I need all your schedules so I can see where those $64,000 are coming from. This is the self-employment income, the Schedule C, and these are the $10,000 that you were seeing up over there. Then he has a rental property. This is the rental property. On the rental property, he has a loss of $1,000. Remember that the K1 was for 65 and you saw 64 because of this minus $1,000. Then you see the K1 at $65,000, and it should be here in this schedule. So if you add 65 minus the 1,400, those are the $64,000 that you see up there. Make sense? Okay, so let's go back to the corporate taxes. in the corporate taxes, let me see if it's not one of you. In the corporate taxes, in the last meeting, Jorge talked about depreciation. And depreciation basically was, what was the definition of depreciation, Jorge?
It was loss of value due to wear and tear.
It was the loss of value due to wear and tear on an asset. Now, if it has lost the value, the IRS lets you deduct that loss of value from your taxes. Correct, Jorge? So if I have a vehicle and the vehicle cost me $100,000 and it lost the value $20,000, what the IRS is saying, well, that vehicle, Oscar, is not worth $100,000 anymore. It's worth $80,000 because it lost the value. It depreciated $20,000. Now, those $20,000 that depreciated, what I'm going to allow you to do, Oscar, is that I'm going to allow you to deduct it from your taxes. If the IRS allows me to deduct it from my taxes, the depreciation on line 14, was it at an expense or not? Was it an actual bill that the client paid? No. If it's not a bill that the client paid, I can add it as income. I can add it as income. So I'm going to show you another corporate taxes where it does have depreciation. Now the K1 is going to read 65, but if I have on depreciation $20,000, now I can add $20,000 to my income. Make sense? Make sense? So let's look at that tax. Make sense, David? Okay, so let's look at this one. And this one actually does have depreciation on the line 14. So this client, this business, it made $2 million. Cost of goods, they spent $900, so they made actually $1 million in a year. Depending on the accountant, you're gonna see multiple things where they declare the salaries. And it could be a headache for you guys, but it's just the nature of the business of accountants. So in reality, the owner of this company, if they receive salary, which in this case they did, it should have been on line 7, compensation to officers. But this particular accountant, he puts salaries, everyone, on the line number 2, which is salaries and wages. And they put everyone. The secretary, the guy working on the line, everyone, they put it on salary, and the officers, they put it on salary. So this number is not going to match my W-2s now, because it's salary for the whole company. But as long as I can prove that I have a W-2 and the W-2 is coming from this company, I'm okay with my client. Now, the W-2, we're going to leave it right now. We're going to leave it on the side. Now, if you have a company, Fernanda, if you have a company, do you need to pay yourself W-2? No. It could be that this client doesn't have W-2 income. It could be that this client doesn't have it, and it only has a K1. It only has a K1. It could be that way. So when you do corporate taxes, you can pay yourself by K1, you can pay yourself by W-2, you can pay yourself with both, or you can pay yourself with neither one. So on this one, I have $17,000. $17,000, it should be on the K1. If I go to my K1, and my client is Margarita, if I go to the K1, of Margarita, it was $17,000. There's only $14,000. Why there's only $14,000? Because, sorry, Pulido. Because she's only owner 80%. Now her husband is owner 10%, and then there's another guy owns 10% of the company. So there's another K1, and this is the husband, if I'm not mistaken, and the husband owns 10%, so that we're at 90. So they should be another K1 to another person with 10%. In the case on Ronnie and I were 50-50 with the company. We don't pay ourselves K1s. We don't pay ourselves K1s. What it means is the company pays taxes. The company pays taxes, and the money that the company makes, it stays in the company. Why? Because I have to pay salaries, I have to pay expenses. So all the money we leave it at the company. We don't pay ourselves K1s. So, but if we pay ourselves K1s, they should be one for Oscar and one for Ronnie. If I'm the one applying, in this case, Margarita is the only one applying because her husband has an I-team. If I'm the only one, or let's just put Margarita. If Margarita is the one applying for the loan, if Margarita is the only one applying for the loan, and who do we have on Zoom, Dawson? So Patricia, just to make sure that you're awake, if Margarita, who owns 80% of the company, is applying for this loan, and I have a depreciation of $26,000, can I use the $26,000 for income for Margarita? Can I use the whole $26,000? So Patricia, Juan, Gonzalo,
Just the 80%.
80% of the $26,000. 80% of the $26,000. So Margarita only owns 80%. If I'm doing a loan for Margarita only, I cannot use the $26,000 as income for Margarita. I can only use 80%. 80%. Make sense?
Yes.
On the application, let me just go into a real quick to an application. This is very important.
Before you move up,
Uh-huh.
let's say Margarita has a W-2 of 120,000. Does the lender is gonna require all the W-2s to make sure that it matches the salaries? So you don't move Margarita's salary?
That's a good question. So I'm going to go back because that's a good question. Can we go back to my email? Do I just go to Gmail? Okay. So what Maria is asking she's asking, well, if she's only owner, let's just say 50%, for example, Ronnie and I. So is the lender going to require all the W-2s? The answer is no. But they're going to require all the W-2s on Margarita's 1040s. So now, on Margarita's personal taxes, with her husband, there's $191,000. There's $191,000. The first assumption that you will make is how much of this income is Margarita's? If I tell you that the income is coming from the corporation, what will be your assumption that Margarita is making on this one? 80% of 181, unless you provide the W-2s. Now the W-2s, it tells you a different story. The W-2s, this I'm going to require all W-2s. I need to see all the W-2s that match the 191. That we're going to require. We're not going to require all the W-2s from the company. We only require the 181 that are on the personal taxes. And the W-2s on the personal taxes, which it was, until I asked for them, it was obviously, like the American people says, fresh water, like San Antonio. Mario, the husband, makes $83,000 and Margarita makes 107. So it's not an 80-20 or it's not an 80-10. Mario, the husband, made $80,000, so those are 191, and Margarita made 107. So what is the income that I can use for Margarita? 107. If Margarita increased her salary, to $200,000, can I use the salary now? No,
No.
because she's self-employed. Because she's self-employed. So I can use 107. I can use the 80% of the $17,000, and I can use the 80% of the depreciation of the $26,000. Then that's her income. Make sense?
Yes.
See, makes sense. Okay, so what I wanted to show you was on the application. So on the application, I don't know if you have seen it, but you need to be responding to this. ¿Dónde está Margarita aquí? Okay. Okay, so I don't know if you guys respond to this question or not, but on the application, when I declare the job for Margarita, Margarita works at this company. She's self-employed on the bottom. And on the very bottom, I cannot make this one bigger from the mouse, but on the very bottom, it says ownership share off. And it asks you a question, if she owns 25% or more. You need to be responding on every self-employment this question. Now, if she has a corporation, can you put it on the top so I can see that question? So if for whatever reason you run into a Kaiser doctor, they treat them as partners. And partners, with partnership in Kaiser, do you know the amount of Kaiser, that amount of money that they make? So the amount of money that they're partners, but they're partners 1%. And at 1%, they make a salary of about $500,000 or something like that. But he's self-employed, he receives a K-1, and the ownership of this doctor is less than 25%. If it's less than 25%, am I going to require the corporate taxes? No. If he owns less than 25% of the corporation, I don't need the 1120s.
How do you know? And that's the
Oscar,
And the K1, it says.
So they're gonna ask you for the K1.
And they're going to ask you for the K1 because the K1 is the way that he makes his taxes.
So-
That is like the W2.
So his personal taxes is gonna be on K1, and then right there is gonna say that.
That is correct. And it's going to show the ownership, and the ownership is 1%. So this is less than 25%, and I don't provide the corporate taxes. Yes, Gonzalo?
so if the client is less than 20%, we cannot use any income from the corp, right? That what means, because you don't show.
You're not
tax
required to show it. You're not required to show it. Because in the case of the husband, if the husband was applying for it, the husband, how much owner was the husband? Do you remember? 10%. So
10.
in the case of the husband, if I ask him, if he owns with 10 other guys, and one of those 10 takes care of the accounting, and one of those 10, Gonzalo, is Angelo, do you think that Angelo is going to give you the corporate taxes to you who own another 10% so you can apply for the loan?
Yeah.
No, Angelo is not going to give you those taxes. He's going to say, well, no, it's private, it's personal, blah, 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 blah. So it becomes a headache. It becomes a headache asking for the corporate taxes for a person. In this case, it's the husband. So in the husband, they can provide the corporate taxes, and I can use depreciation if I want to. In this case, they can provide, I can use depreciation, I can do that. But in the case that I put that you owns 5% and Angelo owns 20%, Angelo will never give you the corporate taxes. Never give you the corporate taxes.
Now, with the IRS, when you ask for the transcripts, it's gonna show the K1 from the income.
Only the personal taxes. Since we don't require the corporate taxes, only the personal taxes. And the personal taxes will show a K1 income.
10%.
So Oscar, that one means if the client is the owner less than 20%, you cannot use any income from the corp, right?
No, that doesn't mean that, Gonzalo. It means that you're not required to show the corporate taxes. It means that you're not required to show the corporate taxes. So if you own 20% and you have depreciation and you show me the corporate taxes, then that means that I can use the depreciation from the corporate taxes. But you're not required to show them. Two different things.
Okay.
Mhm.
On the other side of it, the corporation can have a loss.
Uh-huh.
If you owe less than 25%,
Uh-huh.
then you're not gonna be hit for that loss.
Mhm. Any other questions?
So in the depreciation would be in relation to the ownership, let's say 20%.
That is correct.
20% of the depreciation.
That is correct. So in the case that Kaiser depreciates $1 billion, then in this doctor, if he owns 1%, then I can depreciate 1% of $1 billion, and that will be his income.
But then you're not gonna see it.
If Kaiser is willing to give me the corporate taxes, then I'll see it. You're not required to. You're not required to. Kaiser will never give me corporate taxes.
But it's gonna show on the client's income?
It doesn't show on the client's income, it's depreciation.
No, I'm sorry, it's gonna show on the client's taxes and depreciation?
No,
No.
no. No, it's only on the corporate tax. Any other question? Comments?
One more question. Let's say they pay in a truck then for the employee, for the business.
Uh-huh.
And we have the 12 canceled checks from the business. And it's under, let's say Oscar's. And are we gonna be able to remove that liability and at the same time use the depreciation?
Say that again. I'm sorry. I got lost a little bit.
So there's a business card,
Uh-huh.
okay, that we get depreciation on the business.
Uh-huh.
Okay, now and then it's not under your credit report.
Uh-huh.
So we're gonna take off that card payment because we can provide that business is paying for it. So you're not responsible for the debt.
Uh-huh.
But at the same time, we able to use the depreciation on the card?
Yes. If it's on the corporate taxes, yes. Yes, because that's a great question, but yes. They don't make any difference.
It didn't make sense, but if it's good.
So I'm gonna give you that response in a minute. So when Maria asked, and this is very important, the first client that we evaluated it was a realtor. The first client that we evaluated was a realtor. Now this realtor has personal taxes and corporate taxes. He has a management company, and the management company he manages on the corporate taxes, and his realtor business he manages under the Schedule C. Now the management company, when Maria says if this realtor got a car, and the car is being expense on the corporate taxes, and you prove to me that you pay the vehicle with 12 canceled checks from the company bank statement, then you can take it off your credit report. But two things need to happen. One, you need to see the vehicle on the taxes is being expensed. And two, you need to prove that that vehicle is being paid by the corporation. But I pay it from my personal bank account. Now you're out of luck.
You need to prove that the vehicle belongs to the corp with they're gonna ask you for additional.
No. If it's a company, so I have my car and I have the company Simply Mortgage. If I show that I paid the vehicle out of my Simply Mortgage account, that vehicle is not a liability for me.
You don't need a registration to Simply Mortgage.
That is correct. Now, that vehicle got depreciated. So when Maria is saying that vehicle got depreciated, so if you already took it out from your credit report, but it got depreciated, can I use the income from the depreciation? The answer is yes, because depreciation was not an expense. So you didn't took the expense, you took the value of the vehicle. And the value of the vehicle is something that the company owns. And if you depreciate it, you can add that income. Regardless whether it was on your credit or not. Make sense? A little bit confusing, but makes sense. Any other questions? And help me out with this training, because obviously there's a lot of multiple parts that move here.
I have a question.
Uh-huh.
I don't know if you're gonna touch on that, but I have a client, roofing company, declared 250,000 net, but for some reason, the way that he does his taxes is totally different income from conventional to FHA. Like in FHA, I have a lot of income because they add additional, what is it, and the taxes on the corp taxes, the 65,000, if you see it on the bottom, you can add it back as income, but you cannot add it on conventional.
Okay.
Like that. So I have two different scenarios, the same client, but very bad on conventional, excellent.
All right. We're going to talk a little bit about that and see if Julio can help us also with that answer. So let's just go into that. Does it make sense what we just talked about? Now, the last thing, I don't have an example right now. I'm sorry that I didn't prepare correctly. I don't have an example for you to show you right now, but let me just go back. Let me just go back to this corporate taxes. So what I told you is that in this specific case, $17,000, if I'm the sole owner of this corporation, I should see a K1 of $17,000. Now, the way that Ronnie and I make the taxes, is that we make $17,000 in a year. That was a joke. We make $17,000 in the year, and then we pay taxes. The taxes are in this area. So we pay taxes, and let's just pretend that if we pay taxes for $17,000, we pay taxes $2,000. So if we pay taxes $2,000, then we're left with $15,000. Can I use the $15,000 as income if I'm the sole owner? What is the amount that I can use? The 17,000 or the 15,000? The 17,000, Maria, going once. The income that I can use is the 15,000 because I already paid taxes. And if I already paid taxes, what is the money that I got left? $15,000. So $15,000 is the only amount that I can dispose of because I pay taxes. So I don't have 17 anymore. I had 17, I paid taxes. Now I'm left with 15. 15 I can use. Now if I'm 50-50 owner, then I can use 75. But 15 is the one. So be very careful. It's not this line. If you see numbers here, it means that he paid taxes. And whatever number is left at the very end, that's the amount that you can use. Make sense? That's the way that Ronnie and I make our taxes. We don't distribute K1s.
It's not common to see that way.
It's not very common to see that. It's not very common to see that. The reason that it's not very common, David?
So, incorporate income is different from the business income, like you use the Schedule C, line 32.
That is different. That is different. Now, Maria said it's not very common. Why is it not very common? Can anyone tell me why it's not very common to see that the corporation pay taxes? I'm gonna go back to Ronnie and I. Ronnie and I, we made $200,000. Out of the $200,000, I was able to get 100, and Ronnie was able to get 100. Yes, but we didn't do that. We decided to pay taxes on the 200. If we pay taxes on the 200, we pay $30,000 in taxes. What money is left? 170. Correct? Now, if I need money, how many taxes I pay? I didn't pay anything on the $100,000 because I didn't distribute that money to me. There's no K1, so I didn't pay taxes on the 100. The corporation paid taxes on the $200,000, not me. Now, I'm left with 170. Ronnie just emailed me this morning, and Ronnie says, hey man, I need to pay my taxes. I'm gonna get money from the company. Are you willing to get money also? Oh, okay. So how much money we have in the corporation? 170. If I take $50,000, and if Ronnie takes $50,000, guess what? Ronnie and I were going to pay taxes on those $50,000. On the personal ones. So you got taxed double. You got taxed on the corporation, and then you got taxed on the personal. That's why it's not very common. That's why Maria says it's not very common, right? No, because if I just take the $17,000 and I shoot it over to the personal pays taxes, and you only pay taxes once. But if I pay taxes on the corporation, now I'm left with 170. Once I want to grab that money and transfer it to the personal taxes, now I need to pay taxes on the personal taxes. I got hit double, personal and corporation taxes.
That doesn't make sense, huh?
Can I mention something? Because so one of the things that I wanted to add is that I'm going to go back to the LLC, right? Because there's different type of corporations, and I think this is where we're getting confused. LLC is a type of corporation. A corporation C is a different type of corporation. Okay,
So what Oscar was saying and everything that he's been talking about with K1s is an LLC. Meaning that on an LLC, no matter how much money the company makes, you're the one that is going to get the bill. Because you're going to get a distribution, either you like it or not. So I'll give you an example. You have an LLC, and the LLC made $200,000. That was the income of the LLC. You will get, if you're the only owner of that corporation, those $200,000 is going to go to you, to your personal income. And you're going to have to pay taxes yourself on your 1040s. That's why you see the K1s. Okay. So if Juan and I are the owners of an LLC, corporation LLC, and we made $200,000, he's going to get 100 K1, and I'm going to get 100 K1. He's going to have to pay taxes on those 100,000. I'm going to have to pay taxes on those 100,000, right? But see, the thing is that if you're a C corporation, it doesn't work the same way. And that's what Oscar was saying. On a C corporation, you pay taxes on what the company made. So let's say, for example, same example. Company makes 200,000, the corporation has to pay taxes on 200,000. It doesn't give us any K1s. Now, if I take money out of it, so let's say, for example, that's why a lot of CPAs don't recommend the C corporation, because on the C corporation, you pay double tax. So let's say, for example, that the C corporation makes 200,000, pays taxes on 200,000. But now let's say, same example, Juan wants his 100,000 and I want 100,000, then we would have to pay additionally taxes on those 100,000 for Juan and those 100,000 for me, for myself. Okay, so it's a big difference. Any questions on that?
So in that case, you give yourself a 1099 or it's still a K1?
No, it's called a distribution. It's not a K1. It's just income. It's income. It's just like a W-2. So the thing is that, well, that's one thing. Okay, that's one thing. So the other thing is that when you qualify someone, so I'll give you an example. I qualify someone that has an LLC. And because you have an LLC, you can actually see the income of that LLC. How can you see the income on the personal taxes? With the K1, right? So you see it. So the CPAs are very jealous. And like Oscar said, the CPAs don't want to send you the corporation taxes, the LLC taxes. So there was a guy that came in, he wanted to get pre-qualified. I saw the K1 and it was an income of $80,000. So I said, hey, let me take a look at the corporation taxes, the LLC taxes, the 1120s. The CPA said, why do you want to see them? If you already have the K1, that was his income. Why do you think that I wanted to see the 1120s? Well, first of all, because the underwriter was going to ask for them, because he was more than 25% ownership. And like Oscar says, hey, you're more than 25%, they're going to ask you for the corporation. But I needed to see the taxes right there on the pre-qualification process. The question is why?
Because make sure that it didn't report losses.
Losses, or I can use additional income on depreciation. Because the K1 is not going to tell me about the depreciation. See, the K1 is telling me, hey, he made 80,000, and that was the point of the CPA. What do you need the 1120s? He made 80,000. You can see the K1 on the 1040s. Well, yeah, but I need to see if he made depreciation. I'll give you an example. There was a guy that his income on the 1120s was 175,000. But guess what the depreciation was? 325,000 of depreciation. And he's 100% owner of that company. Do you think that it's important to see the corporation taxes? Of course it's important. Why? Because of the depreciation. So when someone comes in and shows you the 1040s and you see a K1, it means that he what? Owns the company, owns an LLC, right? You want to see the corporate taxes. You want to see those 1120s because you want to see if there's depreciation. Now, check this out. Yes, David.
So how they calculate the depreciation? Let's say you buy a car with the corporation, they deduct 20% every year.
Mhm.
So that means in 5 years, you're not gonna be able to depreciate it, or how it works?
Usually, that's how they do it, but it's kind of like a CPA call, right? Because sometimes a CPA can say, hey, we're gonna take 100% of the vehicle and we're gonna depreciate it in only 1 year. Some of them will say 5 years. So it's kind of like a CPA call, yes. Yeah. So now, check this out. If it's a C corporation, that's totally different because you're not gonna see it anywhere. Okay, you're not gonna see it. If you see my personal income taxes, you're not gonna know that I have Century 21 Plaza because that's a C corporation. It doesn't give you a K1. It doesn't get related one to the other. So if you see a K1, I know that you have an LLC. But if I don't see a K1, maybe you do have a C corporation, but I don't know, right? So the thing is that you always ask the client because see, when I do a loan myself, I have 3 different corporations, but they're C corporations. And if it's not to my best interest to put them on the application, I don't put them in because they might have some losses. But if there's income, then I put them in. If there's no income, I don't use them. No one asks for them. The underwriter's not going to ask me for, hey, I want to see Aragon Escrow Solutions. No, I don't want to show it to you. Why? I don't want to show it to you because maybe there's some losses. If there's income, oh, I'll show it to you. Hey, there's income. I'm 50% owner of that one. So use my 50% ownership income, depreciation or whatever. Okay. So, you know, I wanted to make that point, guys, because that could be something that you might get confused on it. So any questions on it? Any comments? David?
If you have 3 corporations. And
Yes.
you said in corporation C, you have to pay double taxes, right? So that's gonna show your personal income, the income from the other corporations, right?
Not necessarily if you don't distribute money.
Correct.
So,
Okay.
so if I don't distribute money and I'm okay with my salary because I get paid W-2, then I get paid W-2 and that's it. But if I distribute money, then there's a distribution form, and that's how you find out that he owns
In
them.
case you pay from the 3 corporations.
That's correct. That's correct.
Correct. Yes. So if you leave the money there, you pay taxes on it and it stays there, you don't get anything.
Podemos quitar la pantalla, de ahí, Dawson, para poder escribir. So just so we can finish, toda la pantalla, nomás quiero usar el pizarrón. Pero ahí se puede. Okay. So since he's my brother and we have done loans for him, I know a little bit about his situation. This is the companies that Jorge owns. I can share them. So one he owns an escrow company. Another one he owns C21. Another one is Movita, which is the juice bar. And then there's another one that owns with property management, with Enrique, property construction or management. Now, do you get paid W-2s from these companies, Jorge? No. No. So he doesn't get paid. This one's our C Corp. So he doesn't get paid W-2. Only Movita is LLC. So he doesn't get paid W-2s. Now, does he get paid K1s? Well, no K1s because he's a C Corp. So there's no K1s, there's no K1s, there's no K1s. So if Jorge applies for a loan, and this is the worst thing for an underwriter, but it's just the fact of the matter. If Jorge applies for the loan and he doesn't want to share this company, we will never find out that he owns that company. We will never find out that he owns that company. because he doesn't get paid W-2s, he doesn't get paid K-1s. And so he's not showing any income on his personal taxes. Now, if for whatever reason, myself personally, I'm a C Corp, but myself personally, with Simply, I don't get paid at K-1, but I do get paid at W-2. If you get paid at W-2, our job as underwriters is to see who's the owner of this company. So when we see Simply Mortgage, even though the Simply Mortgage has nothing to do with Campos or anything, we're going to check if Simply Mortgage, who is the owners of the company. And if I'm the owner of the company, then they're going to ask me for the corporate taxes. Make sense? So sometimes the underwriter can miss it. Sometimes the underwriter is going to say, hey, Simply Mortgage, you're the owner, Oscar, you're applying for a loan, show me your corporate taxes, C Corp. But in this cases with Jorge, we were never going to find out that Jorge owns those ones. Make sense? Questions? Okay. The corporation taxes are very important. The corporation taxes are very important. The last thing, I usually don't even do this. I usually don't even do this when I'm qualifying a client. But you have to, because you can get bite on the yes. So in the corporation, and we're going to talk about, for example, Movita. COVID happened. And COVID happened in 2020, 2021. And you receive a loan, Jorge. There's two types of credits from the government. One was a loan, and another one was one that is more recent, which is the employee retention loan. We're not going to talk about the employee retention loan right now, but you receive a loan, right, Jorge? And you have tons of Movitas and tons of employees. That loan, how much was it for? $600,000. So he received from the government a loan for $600,000. Here's the $600,000, and they deposited that money into your account, right? Okay. It was a loan. Since it's a loan, they don't pay taxes on it because it was a loan. Now, but it was still considered a loan. What was the name of it? The loan? PPI or something like that. So Jorge on Movita, it could be not Jorge, but it happened with another client. It could be that the client made a gross income of 150, and let's just say that's a bad example. A gross of 1,150,000, and then he basically had expenses of 1,300,000. So he was negative 150. But guess what? He paid himself $300,000. Why did he pay himself $300,000? Because he had a loan. So he had a loan. So that's how he was able to pay himself $300,000. The loan, you don't see it on the first page, but you see it on the liquidity test. A liquidity test is, okay, show me that you can get this money. I mean, don't. So if you pay yourself $300,000, how are you able to pay yourself at $300,000 on a W-2 if you lost 150? Because he had a loan, and with that loan, he paid himself. So there's a place on the taxes, I'm going to show you in a minute. There's a place on the taxes where you have to evaluate the K-1, and you have to evaluate on the corporate taxes if you have enough liquidity. If you have enough liquidity to pay yourself that amount that you're saying, that you don't have any loans. So does it make sense, this?
In that case, did they took him the 300?
In that case, PPIs was a loan, but what were they saying on the loans, on this types of loans, Jorge? Forgive. That they were forgivable loans. So the accountant wrote us a letter saying, hey, he does have a loan, but that's a forgivable loan. Okay, and we use his income. So but we were very lucky that it was this type of loan. We were very lucky that it was very specified on the taxes that it was a PPI loan, and it was a forgivable loan by the accountant. And that's how we were able to do it. Make sense? Okay, so let me show you taxes. Can we go back to the screen real quick? There's a lot of taxes. There's a lot of corporate taxes and a lot of people. So again, you can get paid W-2 and you can get paid K-1. You can get paid W-2 and K-1. For whatever reason, there's a lot of clients, that, and this happens. I get paid W-2, with the W-2 that I get paid from Simply Mortgage, it's enough money for me. It's enough more money to live. It's not enough money to do other stuff, but it's enough money to live. Now, the K-1, it could be that they made the taxes. But in reality, so there's a distribution of $100,000, but in reality, I didn't receive the $100,000. I left them in the company. So I got a K-1 of $100,000. It means that I made that income of $100,000. But if I never got that money, I just pay for the taxes, and that money is already tax-free. But if I never got the money, then the money was never distributed. So on the K1s, it needs to show, and I'm going to show you another one because this is not very clear. Sorry, guys. That Margarita made $14,000, but it needs to show that she distributed herself $14,000. In this K1, it doesn't say anything that she distributed the $14,000. So if it doesn't say that she distributed herself $14,000, let me show you the one from the realtor. In the realtor, he says, I made $65,000, and not only I made $55,000, I pulled myself $100,000. Not only I got paid 65, and I'm going to pay taxes on 65, but I got from the company on this year, I got $100,000. I'm not going to pay yet $100,000, but that's the amount that I distribute myself. Corporation bank account, I got $100,000 from the $65,000 correspondent. So if it says that he distributed this amount, it means that he already got the money and he's already free. But if it doesn't, most of the accountants, I would say 50% of the accountants, not most of them, but 50% of the accountants, they don't put the line distribution. So you can get a client with $100,000 to 65, and there's no line for distribution. So if there's no line for distribution, it means that maybe he never got those $65,000. If he never got those $65,000, it means that $65,000 have to be on the bank account of the company, because he never got those $65,000. So if you're showing a bank account from the corporation and the bank account has 20 and there's no distribution, and you're saying that you got $65,000 and there's no distribution, now you have to get the accountant involved. And you have to say, we did get that money. We just forgot to put this distributed money. Makes sense or not? It's very important. So when the underwriter asks you to write a letter from the CPA saying that he has enough liquidity to distribute the amount, that's the reason that they're asking you for that condition. Why? Because you didn't put that you distribute this amount. If you didn't distribute that amount, it means that the money is in the corporation. If you're using funds from the corporation, then you're showing the funds from the corporation, and the underwriter can ask. So the underwriter he will ask you for more information. Make sense or not? See, David?
So in that case that he's pulling 100,000 and he's paying himself only 65, where could this rest?
In his bank account, because he already pulled that money. Now in the future he has to pay taxes on it, but he distributed 100. Now it could be that he left in the company money, so he already has money from other sales, so he got more money, so it's in his bank account. He later gonna pay taxes on the corporation and everything, but that's how it happened. So it becomes painful. It becomes a little bit painful if this happens, because if you distribute yourself $100,000, there's no distribution. You got yourself on a K1 $100,000. You're not showing a distribution. You're not showing a distribution. And you show a bank account from the corporation, and the corporation has $50,000. $50,000. So then the underwriter is going to say, well, when you distribute 100, but you only have 50, that doesn't make sense. That doesn't make sense. Now, do I ask the CPA for a letter saying that he has enough liquidity? No, because I'm already seeing that you have $50,000. Now you have to prove to me that during the 2021, you did get money from the corporation. You did get money from the corporation. Now it's a different letter from the CPA. He did distribute that amount, and here's the proof that he distributed that amount. It can be a little bit painful with the CPAs. It can be a little painful for the clients, but you have just be mindful of this.
But you asking the letter to help the income on the borrower?
No, you're asking the letter to prove that he made that money. To prove that he made that money.
That's 65,000.
So let's just pretend this, Maria. Let's just pretend you have a corporation. You have a corporation with Angelo. What's the name of it? Marketing Choice Marketing. Now you have a corporation. The corporation made $100,000. From the $100,000, 50 belongs to you and 50 belongs to Angelo. So you and Angelo can decide to say, well, okay, we're going to pay taxes on our personal taxes for the 50, but we actually never got the money. We actually never got the money. We just left it there. So the money is $100,000 on Choice Marketing, but you already pay taxes on it. So you transfer a K1 to you, and you transfer a K1 to Angelo, and because you have another business and you make money from the other business, then you didn't have to pull this money. So if no money was distributed to you, if no money was here, it doesn't say that it was distributed $50,000. Then at least Maria showed me that on this bank account you have $100,000 for whenever you want to distribute your $50,000, you have enough money. Make sense? Now, there's a lot of times where the K1 reads $200,000 and the bank account of the corporation it has $100,000. Well, how in the hell you're going to distribute it? Because the accountant never forgot to put the distribution. And since the accountant forgot to put the distribution, now you have to prove that in reality in 2022, you did get money out of the corporation. Here's my proof. Here's checks that I transferred. I did distribute the money. So I could have distributed in 2023, and here's the money that I already distributed in 2023. Make sense? But it's only a headache that you have to deal with the underwriter. It's only a headache that you have. In this case, the underwriter is going to ask you what the underwriter does. Then most of us don't do, and I don't blame you because I don't either. They make this test. And this test is the loan that I was talking about. So this loan, he already distributed the amount. He made $65,000. He already distributed even 100, and he has $21,000 in cash. If he has $20,000, how much debt does he have? He doesn't have any debt. If he doesn't have any debt, then he has liquidity. But if he has $21,000, he pulled $100,000, and he has debt of $200,000. Well, what is this debt? I mean, you're negative. I mean, you're only acquiring debt, and you're paying yourself, but you have a lot of debt. So you have to have liquidity. So there's this page, and there's a similar page on other taxes that tells you this is the cash that I have, and this is the debt that I have. If you don't have any debt and you're above 1%, you're okay. Make sense? Just so you can take it on the back pocket if the underwriter asks you in the future. If you have any questions, just let us know. Pulido is very knowledgeable on it, and the underwriter also. Questions, comments? I hope that I didn't confuse you guys. Make sense? Okay, that's it.